If you've been following the Indian markets recently, you might have noticed that they haven't been performing as well as we are used to seeing them. Now take the Nifty 50 for example. It's down by more than 5% in the month of October alone. And if this continues, we would be looking at the worst monthly performance in over 4 years. Now Goldman Sachs, one of the largest global investment banks, has made a move. They've downgraded their outlook on the Indian equities from overweight to neutral. Now this downgrade comes after domestic stocks got downgraded to underweight by Bernstein Research. Now what does this mean exactly? Well, when investment firms like Goldman Sachs assign ratings, they are essentially telling their clients how they feel about a certain market or about a certain stock. Now overweight means that they believe Indian stocks will outperform others and the investors should allocate more of their portfolio to them. But when they downgrade it to neutral, they are saying, hold on, we're not sure anymore. Now they don't expect the Indian stocks to do as well in the near future. So they are advising caution to their customers. Now let's dive a bit deeper into the reasons behind Goldman Sachs' decision and what it means for the Indian investors. Now first, Goldman Sachs pointed out two key factors. One is the high valuations and second is a less supportive global backdrop. Now the Indian stocks have been trading at higher valuations compared to the other emerging markets, meaning that investors are paying more for each rupee of earnings. Now when valuations are usually high, the potential for further growth increases and it's tend to be limited unless there is a strong growth story to back it up. Now and right now with global uncertainties, be it the rising interest rates, be it the inflationary pressures or just the global geopolitical tensions which are ongoing, the external environment isn't given much support either. However, and this is crucial for you to understand, a price correction in the Indian markets is unlikely thanks to the robust domestic flows. Now what does this mean exactly? Essentially, despite these global headwinds and high valuations, the strength of the India's internal market, particularly the domestic investors, mutual funds and the institutional investors, remains a stabilizing force. The Indian retail investors have grown significantly in the recent years and their continued participation is helping the market remain resilient even when foreign institutional investors pull back. Now, while the structural appeal of the Indian equities remain intact, Goldman Sachs did acknowledge that economic growth and corporate profits have started to slow down a little. Now, this has caused them to adjust their 12-month target for the Nifty 50 to 27,000 levels, down slightly from the previous forecast of 27,500. Now, this still implies a 9% upside potential, but it suggests tempered optimism, which means that there's room for growth, but it might not be as strong and as swift as before. Now, what does the Goldman Sachs then recommend to its customers? They are advising investors to prioritize quality, meaning companies with solid fundamentals, earnings visibility, meaning those whose future profits are more predictable and targeted alpha themes, which are specific strategies that can outperform in the uncertain times. Now, what does all of this mean for you and I as an investor? Let's take a step back and look at the bigger picture. Yes, Goldman Sachs has adjusted its outlook, but this doesn't change the fact that India as a market remains fundamentally strong. So while we may face temporarily slowdowns or periods of market volatility, India's long-term growth story remains intact. Now, investors with a long-term view should focus on quality businesses, industries which are poised for growth, and companies that are innovating to stay ahead. India is in a unique position to benefit from both internal strengths and the global opportunities. So don't miss out. With that, this is Raj Mehta signing off, wishing you and your loved ones the very best. Thank you.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.